How's it going, everybody? Welcome to the very first webinar of 2025, the Catalyst Funding Real Estate Market Update. I'm here with our host, Wade Comeaux, Jeff Johnson, and our special guest here, Stephen Curtis. Wanted to invite you guys all out. Thank you for joining us. Just a short disclaimer here. Please make sure to do your own due diligence whenever you're looking into any investing, and make sure that you are checking on those lists and double checking it. So gonna push it off over to you, Wade, and please take it away.
Absolutely. Thanks for the intro, David. And super excited to have Stephen here today. We have a few different guests in different categories of lending and real estate investing, but Stephen is without question the most knowledgeable that we speak with in the areas of traditional mortgage lending, interest rates, trends. So we always love to have him. I think he brings some great insight. So, Stephen, tell us what's going on at NRL and what big things are going on in your world.
Yeah, so at NRL, things are going well. Last year, we made a lot of positive revisions and even onboarded some new programs that, especially in the non-QM space, we feel are game changers. And a lot of independent mortgage banks, Wade, do not have the ability to have delegated authority on these, which means we underwrite them, we close them, we fund them. So when we tell people we can do a bank statement or DSCR loan in 19 days, they kind of laugh a little bit. But we do it all the time. We have designated underwriters to do them. We have designated closers and funders to do them. It's part of the lifeblood of our company. And I think that's a little bit different. And we're rooted right here in Houston. So, we had a great success with our non-QM products over 2025. A lot of opportunity in the market. Obviously, we're getting a lot more inventory. And as far as rates go, we have some things on the horizon that we're excited about. I think tomorrow's PCE report will not be in our favor. So we're telling everybody to potentially lock ahead of that. But we have some things coming behind that we think will help us if we get a little spike. About 3 weeks ago, we had about a 220 basis point decline over 10 days. That's fast.
Yeah.
Since then, we've made up about 70% of that. So we're starting to creep back. And, we have some policies that we think are going to, push inflation down over time, maybe not immediately, but definitely over time with energy costs potentially going down. And we think that that's going to be a positive for rates. So we do think that the Fed potentially will change its hawkish position maybe in Q2, and they might actually announce some cuts in Q3, 4.
Yeah. Um, I'll tag on to the thing that you said first about DSCR loans in that it's been a powerful change for us. Like our DSCR pipeline is really growing significantly right now. And me and Jeff and Ernest were talking about it because we're very excited about it. And there's two additional things into what you just mentioned, that the internal underwrite, complete game changer. We used to broker all of these products, and it would take us maybe the 17 days to get a file ready, but then you would send it off to other people, and then that might take 30, 45, 60 days. Like the internal process that you controlled was so limited relative to the overall time frame, and also just the interaction. You know, multiple requests for different steps, things not being reviewed that were already submitted. It was just a very kludgy and difficult process. But with the internal underwrite, it is a game changer. Like our turn times are incredibly fast. And there are two other big product differentiators that we have as well. One, in this hard money to permanent refinance strategy with DSCR loans, the fact that there is no requirement for seasoning if you have the appropriate FICO score, and also no requirement for the property to be leased, is a game changer. And then we're able to also do the bridge appraisals that we've done for a decade now on conventional loans, but being able to do those on DSCR loans where you're able to use that same appraisal for both the hard money and the long term. Those three things in concert, we're really crushing the DSCR loans right now. So can't thank you and the NRL team enough for being a leader in that category.
Yeah, and we appreciate the partnership. And we're an aggressive company. If we have outlets to move these loans and sell them and have servicing taken care of, then we're going to do them. And we aggressively shopped for multiple outlets. And the thing that people, if you're on the call and you don't know how important delegated underwriting is, imagine the fact that Wade and Jeff know their underwriters' names.
Mhm.
They can call them, and it's every file they have the same one or two people. So you get to
Yep.
know them. You get to create a synergy with them where you know how they want their files, they know how you submit your files, and it just gets faster. Sending it off to somebody that you have no relationship with or no way of contacting um, is just a lower level of service that we just do not want to offer. So yeah, all around, it's been a game changer.
Yeah, and
Yeah.
we're a Houston-based, sorry, Jeff, real quick. We're a Houston-based company. They're up this, we're in the same building as NRL now at Catalyst. We're of course those of you that don't know, we have the dual employee model where a lot of people are employees of Catalyst, but also employees of NRL. And being in the same building, getting to build personal relationships, the trust that we have, to your point, Stephen, has just been incredible. Sorry to cut you off, Jeff. You
That's okay. I was just going to clarify. It's like in case you couldn't tell from the shirt, like
have
we're Catalyst and NRL are that is who we do our long-term loans with. So we're all employees of NRL. We work at NRL. We would love to have Stephen on, even if we didn't work for NRL, but we do. So it's even better, right? So all of the things we're talking about that Stephen talked about is what we do. The other thing I saw a question in the chat. It says when you go from a hard money to a long-term financing, is that long-term financing a DSCR loan or a conventional loan? Well, it can be both. It can be either or. So to answer, for those of you that want to learn about real estate investing, long-term conventional loans are going to have the best pricing, but it also has the most difficult underwriting guidelines. So you have to prove your income. There's a DU underwrite you have to qualify for. Long-term DSCR loans are long-term. They're a way to get your hard money into a long-term, but it's based on the property. There are way fewer requirements. The cash flow is what matters. And honestly, even if it doesn't cash flow, you can still get in and out of that deal. So either one will work. The DSCR pricing is typically a lot more expensive than conventional, but these days it's not. The difference between DSCR pricing and conventional is pretty narrow. So if you want to be an investor, both options work great for anybody.
Yeah,
Yeah.
I think another thing to add to that, Jeff, is the DSCR loan of recent. If you really look at total cost of acquisition, conventional loans can be cumbersome on the investment side, right? They have some very high loan level pricing adjustments that are set at the Fannie and Freddie level. That you don't see all of those with DSCR across different FICO bands. And what I mean by that is like once you clear the 660 hurdle, as you go up, there is a little bit less risk in your price. And sometimes if you're really looking at cash in, like actual liquid money, sometimes DSCR can be better for you. So you just got to look at both, and you got to be working with people like Catalyst that know how to present those options to you.
Yeah, to Stephen's point, our approach when working with an investor is that with that one credit pull, we can get you pre-qualified for the hard money lending to purchase and repair distressed real estate, as well as putting you in the best product for you as an individual. Our loan officers and our processing team, underwriting team are experts at reviewing tax returns. So just because you're self-employed does not mean DSCR is the best option for you, but we're always going to look at both and present both so that you understand what your options are. To Stephen's point, sometimes if you're a busy professional, maybe an extra quarter, half point in fees may not be worth submitting all the additional documents and going through the additional hurdles that a conventional loan is. But you have the option of choosing which one works best for you personally, as long as we're transparent and making sure you know what your options are. So DSCR is really, really a game changer for sure.
And then the last thing I'll add, Wade, just in case people don't know, um, being the chief production officer, leading production for the whole country, and then having Catalyst as our really only group that is doing this work. We're always looking to improve. So this process, although has been completely refined and improved over the last year, we're just getting started. And my relationship with Wade runs almost 23 years. So we have a lot of comfort in trying to figure out like where can we get comfortable, where can we speed things up, where can we make ease of use for our investors. And I just don't know that there's another 1-2 relationship like that in this space. So I think it gives, when you work with Catalyst, I think it gives you a leg up for sure.
Absolutely. And that just the customer service and passion for speed that Steve and the team there have, it's just really, really incredible. That was one of the things Steve said whenever he came in, like we're going to be passionate about speed, interaction with clients, availability, and getting things done in the most efficient way possible. And it's been a totally different experience for us from where we were before. We were at the previous company for 6, 7 years, and it was great in many ways, but it's a different level of experience for us now for sure. So Steve, thank to you and your leadership, and I know our clients love it as well.
Perfect.
All right, so going to the quick things on the value propositions. We talked about the categories we're in. Just another quick reminder is that we do have that 5-star customer experience across all platforms. So you can always check us out on Google and Facebook to see that. And then we're also really very happy with the panel of appraisers that we use that specialize in investment properties. That's another uniqueness. If you're working with a national lender, and also many of our competitors that don't have as much ability to put really high quality appraisers that understand the investment space. That's such a big difference. If you're working with appraisers who don't do deals like this, they walk into a house that has, it's demolished, it has, animal feces and like other bad things going on. They can often really be afraid of giving you a fair value. And our guys are very good. Our appraisers are very good at giving you the highest ethical value by not being afraid of things whenever they look at that scope of work and repair budget. That's a big difference because, for an investor, you want to put as little dry powder into each transaction as possible. And if you have appraisers who understand the business and are doing ethically fair appraisals, that can make a huge difference. Being out of pocket $20K instead of $30K over time, if you're adding 10 properties, it's a total game changer. Anything before we move on to the Houston slide there, Steve or Jeff?
Nope, I don't think so.
I'm ready.
Let's dive into Houston. So Steve, I know this is your neck of the woods. Why don't you walk us through what you see here?
Yeah, so what I find interesting is we just continue to have good appreciation in this market. It's always been fairly insulated. You're going to see Dallas might outkick us as far as appreciation goes, but it's always steady. I can't remember a year other than maybe 07, 08 that we didn't have a 3.5 or greater appreciation. And we've had some years where it's been very high in recent times. So to still get a good appreciation here is a big deal. We're starting to see the home sales climb. We're not to the pre-COVID levels yet, but we're definitely seeing transactions and inventory. So those things are happening at the same time.
Mm-hmm.
To have your transaction count go up and your inventory still make gains means we're in a pretty healthy market. Considering everything that's happening, I think Houston continues to be very steady.
Yeah, considering we're at 4.3% year-over-year appreciation in a market with rates where they are is very exciting. I think we will eventually have some rate relief. I don't think it's going to be at the pace that many of us thought, but whenever we get that rate relief, I think it's going to make a big difference. And the great thing is we're still seeing these deals with so limited out of pocket because the cash flows are not what they were whenever rates were lower. But you can always refi that rate eventually, because eventually it's going to get, we'll get 1% relief sometime. And to your point earlier, sometimes you really have to take advantage of that moment whenever rates drop. It's like anything else in life. Don't put off good in the effort of great. If you can lock in a really good rate, that can be a great option for you. Jeff, does anything jump out on Houston for you?
It's just kind of more of the same. Every month we talk about Houston. It's pretty steady. Like it's always kind of relatively steady appreciation. Even the rents, you look over the last 5 years, they're up almost $500. And we talk about rates being high and not having a lot of cash flow, but regardless of the payment, the rents, at least in Houston, have been pretty steady. Even this last year, when rents were relatively depressed, Houston had a little gain, right? Not a lot, but a little bit. So it's a very safe bet if you're looking to park your money on a real estate investment property.
Let's look at Dallas next. So Dallas, we were talking about this earlier, Stephen. The appreciation on both average and median sales prices, 56.5% since COVID, 47.3% since COVID. That's an amazing success story. We're talking, 5 years of over 10% appreciation on average there in Dallas on the average price. And you look at the reasons, incredible amount of major corporations moving in there, really improved job market, really improved average income. And that's just facilitating these huge price increases that blow, candidly, Austin, Houston, and San Antonio out of the water, either on that longer track. Now, admittedly, Houston has a little bit better price appreciation year over year, but really good numbers there from the appreciation standpoint for sure.
Yeah, I mean, I see Dallas as probably the best market amongst the four. It's got the lowest days on market, the lowest months of inventory. It's got a really strong average and immediate increase. I do look down at the lease price, and okay, a -8%. That is something to note. But also, if you look at the 5-year trend, going back to Houston, it was just short of $500. And Dallas is still plus 650, right? So I think they had a steeper run up than say Houston did when it came to the rents. And so that's kind of coming back down a little bit, but over a long haul, it's going to, this, I'm guessing this is a little bit of a blip on the rents, and it'll go back to a relatively more steady increase when it comes to.
Yeah, one of the things I noticed on this slide, and this is right with what you're talking about, Jeff. I think that there's some rent pressure in Dallas because if you look, there's 21% more lease listings. So there's a lot of competition. And when you have competition, you have to be willing to get people into those homes. Nobody wants to be paying the payment. They want a cash flow and they want to have their debt serviced. So if that means you have to take $50 less, I think that happens right now. I think it's temporary because we just have this outlier where they have 21% more lit. So there's tons of listings for rentals. So I think it gives the renter a little bit more negotiating power, but I think it's going to be short-lived.
Yeah. A lot of properties and apartments came on market the last couple of years as well. So to your point, there is a ton of competition out there right now.
Yeah.
Yeah, I think one thing about Dallas, whenever you're thinking about the buy and hold space, we do a lot of flip lending in Dallas, but buy and hold is a secret sauce that we definitely have with our cooperation and partnership with NRL. In Dallas, what's interesting is those home prices are getting to a point where pretty tough to cash flow. 500, that's not really going to work. But if you go further out, like there is just a huge amount of excellent rental properties. If you go north of Dallas, almost even into the right up to the border, right? Even into Oklahoma, some people are going. And in any of these areas that are a little bit further out is just a very robust rental market. So if you're willing to do that as an investor, and Catalyst is willing to lend on those deals as well, that is a really good approach in Dallas that people are having great success with.
Yeah, to your point, we're not seeing a lot of deals in Dallas proper, but we are seeing a lot of deals outside of Dallas where those rents are still healthy, but the prices are significantly lower than, $500,000 per property.
And, Dallas is a little bit like so much of the center of Houston moved, west, Energy Corridor, Katy, so much of businesses have moved that direction over time. Dallas is comparable. So much of the corporate headquarters and higher paying jobs are in that, Plano, Frisco area. North of Dallas, there's a lot going on there. And we see a lot. That's why a lot of these great rentals where to get to downtown Dallas, it's a, hour and a half, 2-hour commute. But to get to some of those really high paying jobs in Plano, Frisco, or maybe similar story in Fort Worth or something like that, it may only be a 30 or 45-minute commute. So there are so many good jobs outside of the core areas in these major metros in Texas that the opportunities are all over the place. So the next slide is San Antonio. Jeff, I'm interested to hear your opinions there. Definitely a different story than the other two cities.
Yeah. So to your point, it is definitely different. San Antonio is, while the other two were plus 2 and +1 on median price, San Antonio is down 6 on average. The other two are +4, and this is down 4.5. So it is experiencing a little more of a pullback for sure. I do still think San Antonio is a good landlord market. The fundamentals are strong. I'm sure you guys we've talked about it on the previous podcasts or webinars rather, about the strike team. And if you're familiar with San Antonio and you are a rehabber and you don't know about the strike team, please pay attention, because it is real, and it's still a great opportunity for people to go in, buy houses, fix them up, and follow the model. But if you do not get permits and do it the right way, you expose yourself to some significant risk and loss. So if you're doing deals in San Antonio, we require permits on every deal in San Antonio, because if you don't, the odds of you getting away with it are almost zero. So just go through the process, spend $1,000, go through the permitting process, which you don't always have to do in Houston or Dallas, but San Antonio is super diligent about it. So just bake that into your numbers. It's an extra $1,000, not the end of the world. So do it right, because otherwise it could cost you a lot. Now, if you are somebody who's willing to do it right and you have good contractors and whatnot, it's a good opportunity, because other people are possibly getting scared off of that space because of the strike team. So if you do have a good process, you have a good GC, you have it down, there's opportunity there for you to grab properties at less out of pocket than you would otherwise.
Yeah, I think what stuck out to me is obviously you see median sales and average sales price going down, but if you look at it, they're not lacking activity. There are transactions happening year over year, 17.2% more home sales. So people are active in that market. It just had a little bit of price pressure. Maybe that's to your benefit, to be honest, because an active market is easy to get comps. And if you can get a home a little bit cheaper, especially in a flip or in a hold, you can get a little cheaper right now, but you know that the desire for the repurchase or rent is there, which we can see in the charts. Maybe this is opportunity. So, I'm a pretty optimistic person. I love 5 months of inventory. You're going to have some opportunity to find some deals there.
Yes. Yes. And I do think whenever we look on the last page, the San Antonio story of having incomes that are very, very comparable to Houston's, but significantly lower home prices, that is a winning story, right? Because there's not a lot of differentiation between San Antonio and Houston income whenever we get to that last page of the affordability index. So keep that in mind as well.
Guys, I don't know. We have another question in the chat.
Oh,
I didn't see it.
Go ahead, Jeff. Do you want to take that one, or do you want me to?
Got to read it.
I'm having a hard time seeing the question. What I'm doing wrong.
So I used hard money to purchase a home for $100K, spent 6 weeks, and $50K fixing it up, so that it now appraises for $200. Am I able to get 75% LTV on the appraised value of $200 and get my money out? So I believe if you spent $50K out of your own pocket, if it's done, then yeah, you do. You can get 75K. Now there are some guidelines.
Yeah,
cash out rules is the issue. So there are cash out limits. That's why
cash out limits of pricing increases too, right?
Yeah.
Pricing adjustments. I think if you're working with a hard money lender that really understands the space, like Catalyst, and understands the hard money refi process, we would probably make sure that you're doing a purchase and also getting the money for the repair, so you're not doing a cash out on the backside, right?
Yeah.
That is the best way to, and kind of the industry standard for people who really understand the buy and hold, fix to rent space. You would be better off there, but we would be able to do something for you there. There'd just be some additional pricing issues. I say issues, pricing adjustments, and maybe some LTV adjustments. We just have to look at.
Yeah. So I'm guessing what this is more of a hypothetical question. So what you would do is we would not give you a loan for 100 and then you spend your own 50 fixing it up. We would we would do an appraisal, a subject to appraisal. And if it appraised for that same 200, let's just say you qualify for the highest number, which would be 75%. So we would give you a loan for 150. So if you can buy it and rehab it for 150, really all you'd have to do is come to the table with your closing costs. Then once it's finished, because you did it this way, there's no seasoning requirements. You could refinance it and have that property paid, refinanced in no time at all. So you're only out of pocket are your closing costs.
Yeah, the other thing I would say is, your 50K is probably better spent liquid so that you can act on another deal if it comes up than
Yeah.
putting your own money into rehab.
Yes.
Yep.
It just doesn't make sense. Cash on, it just doesn't, the return doesn't make sense.
Right. Yes, sir. Good point. Yeah, leverage is the game, right? And maximizing that leverage is the way to go. Let's go to Austin. Steve, what do you see in the Austin numbers?
I know this is a tricky market because we do have some businesses coming. I think in that Northeast Austin area, you're going to start to see a little bit of what you see with Dallas, where you have businesses coming in and opportunities. So I think there's going to be some growth on the outskirts of Austin. The inside of Austin is pretty well built, and it is pretty well price driven, right? We have very, very high average sales prices when you get into the interior of Austin, but there is a lot of opportunity on the outside because there are companies coming in. There are opportunities for, Round Rock ish. That area is big, and there's a lot of, it sits kind of in between where the companies are in and where the university is. So there's a lot of opportunity there for single and multi-unit because those multi-units already exist with the university. So I think there are pockets in Austin that if you can really learn that market, you can do very well in. I don't think people talk about multi-unit enough with Austin because they forget that there's an enormous university there.
Yeah, I think that 2 to 4 space where you can still get a conventional loan is a really good opportunity. And there are even some people that are house hacking out there where they're going into a 4 unit, living in one, renting the other 3. That's another really pro move. And I'm trying to remember the exact guideline adjustments, but I do know it's significantly less out of pocket in those scenarios now than it was a couple years back.
Yeah, if you occupy one, you can get an owner occupied loan term at 10%.
Yeah, that's awesome.
And I believe there's even some now, I think Fannie Mae made some adjustments now where there are some instances where it could be 5%.
Yeah, so that's definitely something, if you are willing to live in one of the units, in a 4 unit or multi-unit, that's anywhere. You can do that in Austin, do that, Dallas, wherever. That's worth definitely speaking to our loan officers about because that can be a really good opportunity. And that's a great stepping stone to getting into multifamily or bigger deals over time to do a nice 4 unit. The returns can be great, a lot less expensive per door. And in the market like Austin, there's a lot of that there. A lot of duplexes, a lot of triplexes, a lot of quadplexes. So it's a really good area for that for sure.
Well, the other thing, you look at Austin, Wade, when you get into 2 to 4 unit, the max loan sizes go up too. So sometimes you can be looking at a $900,000 4 unit that you can use conventional financing and 5 to 10% down. You can't do that in any other scenario.
Yeah, that's a great way to approach it for sure. Yeah, that dry powder we talked about at the beginning, but if you're able to put significantly less out of pocket into a deal, that's great. And we're very aggressive on lending in 2 to 4 unit on hard money. We can provide the money to purchase and repair there, and be even more aggressive if you are getting pre-qualified with us on the backside. So with NRL, so it works out very well. A couple things just on Austin in general. It is nice to see their median sales price going back up. If you remember from the peak, they did go down significantly. I think maybe 15-16% from the peak. So people who bought at that point were a little bit challenged. But if you go and look at it now, we don't have the report today, but Jeff and I saw this a month or 2 ago. The long-term trajectory of appreciation with this big jump up that happened during COVID and they come back down, now it's back on the more long-term trend line, right? So I think they're at a healthy spot now. And there are a lot of good investments in the prognostication for the future is great. In fact, maybe 2 or 3 months ago, there were 2 cities in Texas that were listed as the best long-term appreciation places, and it had to do with some of the pullback. And those were Austin and San Antonio. Like the future projections are even better for there 2, 3, 4, 5 years out than they are in Houston and Austin, according to this prediction. So, and it was I can't remember what it was, but it was a very reputable group and very data driven. So I thought that was interesting as well.
Well, yeah, I would just say that if you're not good at looking at technicals and you just want just some advice to live by. If you're a real estate investor in the state of Texas, if you feel like you're losing on a deal, all you have to do is be patient.
Yeah.
Because the appreciation will bail you out eventually. Get it into a hold, put a renter in it. 2 to 3 years, you're going to be back in the position that you thought you were going to be in. You never have to lose in real estate as long as you're patient.
That's right. That's a great point. It's funny. I had this one property. I was going to wholesale it back in our company's infancy. It was in an area called Sunnyside, and I was like, I didn't feel great about taking that property, but the person backed out at the last minute. And I got stuck with it, and it's by far the most appreciation that I have on any single property. It's just incredible because that market has really, really turned around. It's Museum District West or whatever they call it now, but it's totally been revamped. A lot of new construction.
Med Center South.
My bad, Jeff. I'm sorry. Couldn't remember the exact terminology, but it is really jumped up, and it's a huge success story. Let's go to this next slide, Jeff. I know you like this
I found
slide.
this one. Yeah, I found it just because I know over the last couple of years, and maybe this is not a topic anymore, but I know during COVID and over the last couple of years, I would hear a lot of prognosticators talking about foreclosures and this big boom in foreclosures that was going to happen. And I think that can finally be put to bed. I mean, if you look at these stats, total foreclosures down 10% from 2023. Bank repos also down 13% for 2023, 75% for 2019. It just, this is, I had it, I liked it because it was an annual stat. And so they are able to get a whole of the year. And, for the last 3 years, it's pretty consistent, 0.23, 0.26, 0.23. I think the talk of a massive foreclosure run up it may happen, but it's not going to happen because of anything that's happened in the past. It may be a future type of thing. But I think this is saying and if you go to the next slide, it'll kind of tell you the reasons for it. But, lenders have not been stepping out and making crazy loans like they did during the great financial crisis, right? So 2008. So lenders and borrowers are more cautious, definitely lenders. Also, if you think about it, when foreclosures were high, a lot of it had to do with the fact that the majority of values had pulled back quite a bit. These days, all you hear is that there is low inventory, high prices. So if I'm a person in financial problems, that's fine. I'll just slap it on the market and sell it and be done. Like you have to try really hard to go through foreclosure at this point. Whether you bought it recently, maybe there's not enough equity, but that's got to be the rare case.
People in the last year.
Yeah, I mean, if you bought it in the last year or two, maybe you don't have the equity to pull it together. But other than that, and just about anybody, especially in Texas, should be able to sell these properties and pay off your mortgage.
Yeah, I think some people talked, about the pending foreclosure boom in single family. We just have not really seen that across the country. It's been very limited, in all honesty. And I think, Jeff, you covered many of the reasons, but just to kind of hit a couple of things again, kind of reiterate them. One, we don't have the crazy products we had back then. We don't have the 125% LTVs. We don't have the negative amortization loans where you pay your mortgage every month, the balance goes up. We don't have products going down to 500 FICO. We don't have all these stated income, stated asset programs that we had before. And then the average FICO scores are exponentially higher as well. Like there's more rigid expectations for people to get approved, and the proven ability to pay requirement. All those things are game changers. So I do think the mortgage market in general is in far better position today. Steve, you have any other thoughts on that?
I go back to the word opportunity, and when you hear more restrictive lending policies, I mean, obviously that leads to lower foreclosure numbers, but it also leads to less people that can do this. So if you're in a position where you can be a real estate investor and you can get these loans and you can get the takeout loans to put them in permanent, you have less competition than you've ever had.
Yeah.
And I mean, if that was my passion and how I made all my money, just people on this call, just so you know, I do 5 to 7 flips a year. I'm in it also. I see it. I got 2 right now that aren't selling. I'm going to put renters in them. I'm going to be patient and I'm going to win. I'm not going to lose.
Yeah.
Panic. But you know, I think there's opportunity in everything. And I think the opportunity right now is if you're qualified to be a real estate investor and use leverage, you have very little competition. You have fewer people qualified to do it now than ever.
I think you hit on something really important there, Stephen. And that is if you're looking to be a flipper, flipping in a price point where you have multiple exit strategies is extremely important. If you're buying a $1.5 million flip, you really have to be incredibly well capitalized and willing to discount that property and still make a profit. They can't be thin margins. But if you're doing a deal that's 500,000 and below, and you can qualify for long-term financing, especially conventional, because you don't have to have the DSCR. If you have to have the DSCR, it can get a little bit more sticky, although we can go down as low as 75 and even lower 0.75 DSCR at times. But if you have those multiple exit strategies, you're not married to one and you have so many more options. So I really like flipping in that, 500,000-ish range and below, maybe a little bit higher if you have good rents in that area. And if you have the ability to qualify for conventional financing, that's a real sweet spot for flippers for sure. All right. Let's look at this next slide.
I found this one as well. Just I'll briefly talk about it.
Yeah, sure.
We talk about trends. I know a couple of years ago it was a much hotter topic, but now that the year is over, it's a trend of where people are moving to. This is not people coming from out of state or even natural birth. I think this is literally just like people moving from one state to the next. So your top 5: South Carolina, Idaho, Delaware, North Carolina, Tennessee. And it looks like most of those are right. Although Idaho and Delaware, I guess, are not in the Southeast. If you just look at the map, the majority of the Southeast, minus Louisiana and Mississippi, is a net gainer for sure. Texas is 15th. And I know that's, I don't know if everyone's already decided they're coming here because
that's as a percentage. That's not raw numbers, though. That's a big difference, right?
True. That's true.
So keep that in mind. Texas has a massive population. Florida has a massive population. So
Idaho do not.
Yeah.
Yeah.
I think, Stephen, if you moved to Idaho, I think you'd bump them up to first.
I will tell you right now that Idaho, because in my seat, I see a national trends. Idaho has huge sales price appreciation right now.
They have for some time. A lot of Californians moved to Idaho for sure. Beautiful state. Beautiful state.
Yeah. And so I think the point was, if you look at the Texas chart, we were 7th, 4th, and 9th. But the point that they tried to make is that people are moving. Typically, they're moving with regards to taxes was the one thing they hit on, and the cost of living, right? Just you vote with your feet, right? Economics. If you have a state that you can run a business or you can have a job, especially if you have a remote job and you can do it in a low tax state versus a high tax state, it makes sense. And so if you look back at the previous chart, if you went back, all the states that are in the red, Hawaii, New York, California, Alaska, Illinois, I think other than Alaska, I would say they're all on the higher end of the spectrum when it comes to state taxes. I think Alaska, I was looking it up, I think it has to do more oil and gas than anything else. But the rest of those states it's just an example of people moving away from high tax environments.
I did just look up total net migration from like basically COVID till 2024, and like Florida's number 1, Texas number 2 by a large margin, almost doubling up the next states on a total number, right? That's a big difference than the percentage. All right.
Yeah, this is just by state. By city. So kind of the same data we were looking at, just broken down by city. And as you can see, Dallas, number 1. Austin and Houston are both in the top 10. And then McAllen down in the Valley and Tyler made the top 25.
I will say we have a pretty strong presence in McAllen as a company. A lot of multi-unit down there. A lot of multi-unit being built. So if it's something that you are interested in, If you're in the if you do investing in the Corpus Christi market and you want to go a little further south, ton of multi-unit right now in McAllen.
Yeah, that's interesting. I did not expect when we first got this report, Austin, Dallas, Houston were not surprises. In fact, San Antonio was not on the list, was a little bit of a surprise, but McAllen and Tyler, that's very interesting for sure.
McAllen is a lot due to, and I only know this from another industry that I'm familiar with, but in Dilley, Texas, they are building a land camp for one of the largest shale oil operations that got green lighted 2 years ago, and that's supposed to kick off in like 4 months.
Wow.
So that's one of the nicer towns close to Dilley, Texas.
Dilly?
Dilly.
Never heard of Dilly.
I haven't either.
Well, the oil knows it's there, so
That sounds like I need to learn more about it.
sounds like a
So this next slide, more than 1/3 of homeowners say they'll never sell. And if you combine never sell and not sell in the next 10 years, that number is 61%. So what's very interesting about this, whenever we see these limited inventory numbers, limited sales numbers, I think some of the people that are selling kind of maybe are married to a certain number. It may not be moving as quickly, but there's just not going to be as much inventory out there over time with data like this. So I think that's another compelling reason to think that real estate investors are going to be in a good spot. Less inventory, both in the rental and ownership categories, mean, higher prices in both categories. They should over time. So, we haven't seen in the earlier charts, we haven't seen that lag come to fruition yet of rents catching up with the increases in home prices. But it's always inevitable, but it always takes longer, right? It's just leases. Sometimes they're 12, they're 24, they're 18 months. It's just not as immediate to see that growth, but it is coming. And this data says it should be even more robust over time. So I thought that was pretty interesting. Anything else on this page or the next?
I like the next one. If you look at the next one, the only thing that surprised me was I just assumed, maybe it's because the business I'm in, is that the mortgage at 18%, like this is the reasons why they aren't selling, and you could pick as many as you wanted. So, house paid off. Okay, fine. I like my house location. I really expected, I don't want to give it my low mortgage rate to be a lot higher than 18%, which surprised me a little bit. But no, this is interesting stuff to me.
Yeah, my gut tells me that, when I first look at this data, I would just lump the don't want to give up my low rate with the paid off because their rate is 0 also. They don't want to go anywhere and pay 7%. So you got a lot of transient buyers that have paid cash, and they made out really well in their relocation, and they got in at a good price point. And they probably got enough money to also get an annuity and retire comfortably. And those homes are not going to hit the market for another 18 to 25 years, unless something happens, right? I think we're going to have a lot of homes in 18 to 25 years flood the market. But in the meantime, we are building homes at a clip that we haven't been building in a long time. So inventory will make up the difference. I saw, if you want a quick kind of joke, I saw a funny meme that said, tell me you have a 2% rate without telling me you have a 2% rate. And it's a bedroom with 6 kids in twin beds. We're never moving. We are never moving.
Yeah.
But the other thing that people don't think about is if you have a 2% rate, think about how well you could cash flow on that starter home. It'll offset the 6% you're going to get on the
exactly.
So
where you live is where you live, right? You want to live somewhere you enjoy, not overly.
That's a great point.
Yep. That's a great point, Stephen. A lot of people don't look at it that way. I mean, that may be something, I don't know that we're training our salespeople to say that at the moment either, but that's a good thing to help, as a trusted advisor, talking with somebody, that's really good advice. Just set it up as a rental. You don't have to give up your rate. It's a great point. And candidly, that owner occupied rate, even if you were to put that into a rental at the time you did it, that owner occupied rate is always better than the non-owner occupied rate. There are some people who every time they move into a new home, because they get that owner occupied rate, they kind of move into the next one over time. And I think as long as you wait a year, it's not an issue. Is that right, Steve?
You just have to occupy within 60 days and stay 12 months.
Yeah. So that's a house hack that I know reasonable. Now maybe they don't move every year, but maybe every couple of years, and it could be a great way to add to your portfolio at the lowest possible pricing. Yeah. This next slide is pretty interesting and actually very encouraging for landlords, because as you all know, the big challenge at times can be turnover cost and then vacancy, right? So if you can keep someone in a home, that's whenever you're really making the maximum possible returns. And this says that 33.6 of renters have stayed in the same home for 5+ years. That's up from 28.4% a year, decade ago, sorry, which is up 5%. That's a significant improvement. And then with the generational differences, baby boomers, over a third have rented the same home 10+ years. Man, how great would that be if you have a tenant stays 10 years? Probably very minimal turnover costs.
Right.
I mean, and even, I'm sorry, no turnover costs, but probably very minimal repairs. Because once someone's in a home, they become adjusted to it, just like you do in your own home. If you're going to look at a new home, you have a different standard than you do for the home you live in. Like, little things aren't as big a deal. Yeah.
Right. You have competition. So if somebody's been in your house for 10 years and all of a sudden they leave, you gotta kind of get it to the level of the comps, right? And if that means spending some money, you got to spend some money. So I agree. I saw this and I thought, well, this is great for landlords because nobody wants to move. If you have vacancy for 1 or 2 months out of the year, your cash flow is shot. Like you're not making if you're barely making a couple $100 a month and you go 2 months without that, your profit is wiped out, right? So keeping people in these long leases, even if you're not raising the rent as much, just keeping them there can really affect your cash flows.
Another interesting thing here, Gen Z, over 50% moved in the last year. That's probably not drastically different than if you looked at employment statistics. I think they happen to be a lot more movement amongst that generation. But the good thing about homes is that more often than not, that is someone who's looking for something different, right? They're looking to move into a home. They often have children. They often have ties to a school district or to a school. And that tenant, I think, is a lot more sticky. So that's one of the great advantages of being a single family investor or like a small multifamily investor where you have duplexes and things like that, is that I think that tenant is going to tend to be a lot stickier over time.
Sure. That's why a lot of times if you see deals, people get, at least a while ago, they would get some maybe unrealistic expectations of getting those great deals in good school districts. It's like that people, it's worth it to pay up on those things because, to your point, you're not going to have the turnover most likely that you would in an area that's not the best school district. It's more like a single person type of rental.
Yeah. This next slide, Jeff, you want to walk through a couple of those and get Steve's opinion on
it? This one, yeah, sure. So this is kind of what we're talking about with why they were staying longer. It's just people can't afford to buy a house. So if you're going to rent, unless there's a really good reason why leave into another rental. Rents. So this is kind of what we were talking about earlier. Rents spiked during the pandemic, but have stayed flat for the last couple of years. So that's why you saw in those charts over the 5-year trend, cash flows are up significantly, but over more recent data, they're flat or sometimes down in some markets. And then what we were talking about earlier as well, market factors, a surge in new apartment construction has led to increased supply, keeping rent stable. A lot of apartments were being built over the last couple of years, and they've come online, which has kind of flattened out the single family prices.
Yeah. Next slide. Steve, anything jumping out here?
Well, I'm looking. I just want to make sure this is the shifting trends in renter stability slide.
Yep.
Yeah. Yep.
Yeah, being on the mortgage side, we see the affordability factor being stressed every day.
Hmm.
And I think to the point we made earlier, when you're renting a home and you're comfortable in it, let's say you're renting a, 3-2 with a half bath and a 2-car garage, right? If you're in a rent that you're comfortable with, you're not likely to downsize just so you can purchase. It does not happen. So people want to get more when they're making a move. They want another bedroom, or they want that extra office or whatever. And in the purchase market, sometimes that just prices them out, and then they just stay. So we have that. Plus we have people coming into the workforce all the time, and then we have people that maybe if you bought your home, let's just say 2022 or 3 on the way up on rates, your taxes and insurance have gone up as well. So some of those are coming into the market and they're getting into the rental pool. So there is a lot of demand. There's a lot of demand for rent. The only thing I would just say is, like, to the point here, the inventory for new construction, because it could keep rents flat, but over time, the appreciation on rent and cash flow just continues to climb. So if you are going to do a buy and hold, I think that, like we talked about earlier, the longer that you have it, obviously you're getting a better equity position. You are increasing your net worth. You are having someone else service your debt. I have taught my kids that I don't count debt as debt on my balance sheet if someone else is servicing it. I just don't. I don't
Yep.
see it. Now, when it changes and I got to service it, now it's my problem. But I think that when you have somebody paying a mortgage for you, that you get the appreciation and you get the principal reduction on, there's really not that many over time. There's just nothing that's going to give you the same return.
I think Kiyosaki probably give you a high five on that comment. Dave Ramsey, he may give you a punch in the gut because he wouldn't like that, but I
Well,
tend to go the Kiyosaki route.
he would say if you're cash flowing at a 15-year, then fine.
Yeah, yeah, that's true. He's just the pay down debt guy. But yes, in order to build wealth, you have to be willing to use leverage. That's the reality of it. Like there's, in most instances, most people have real estate as at least a portion of their portfolio, and maximizing leverage is just a good strategy. If you're still able to, but to have safety and security and cash flow, then you want to maximize your leverage.
Absolutely.
Yeah. This next slide is on the rental vacancy rate. I'll cover it quickly. You can see there are more vacancies at the moment, but still historically, other than that outrageous interest rate period from in the 70s and early 80s, we're still probably about as low as you've seen over that time frame. So it is something to be aware of, but I still think historically very strong vacancy numbers overall. And I want to let Steve talk. He touched on interest rates, which is the next slide, a little bit earlier. But Steve, you want to give us some prognostications for the upcoming year?
Yeah. So, for me, I follow this very closely. I know what the Fed's looking at. The PCE report tomorrow is going to show that the core is unchanged. I feel like Powell had an early look at it, which is why he made the comments he did yesterday. But the one way to get out of this thing is, I think this administration will be effective at lowering energy costs. And when you lower energy costs, that's been the most stubborn factor in the inflation
Mhm.
number. So that's going
Right.
to bring down CPI as well as PCE. But what people don't understand about lower energy cost is, if you have lower fuel cost, lower energy cost, transportation cost is less, cost to deliver goods is less, then you start to see it not only at the pump, but you start to see it at the grocery store. You start to see it at the department store. These things do come down. And the other thing, that if you don't understand inflation, it doesn't always mean that prices have to come down. It just means they don't have to change, because you're
Hmm.
month over month, year over year. So if the price of gas today is the exact same as it was a year ago, or if the overall energy cost is the exact same in January of 25 as it was in January 24, that's a net zero. So it didn't go up, right? When you add that into how they balance inflation, that would lower the overall number, even though it didn't become cheaper. It just did not go up. Inflation is only when a product goes up, right? So when we look at the ability to bring that energy cost down, we think that, like I said in the very opening, Q3, Q4, when we start to see those things really take off, I think you could see the Fed maybe reverse its stance once we can get into that low 2% range in PCE and CPI, and maybe signal some cuts in Q3, Q4. And if we can see that, it really helps everybody, right? It spurs all lending rates. The prime rate will go down. Multi-unit will probably start popping up a lot more as well. Right now, it's really hard to get a cap rate on the current rate. But it just spurs the economy all together. We have the ability to do it. I think they're going to do it. Whether or not you agree with the policy, we have to have energy independence in order to get out of this inflationary jam. What we do later, we can discuss. But right now, I think the right move is what the plan is for more drilling and for more oil domestically.
Yeah, I will say another thing is there are a massive amount of bonds coming up to be refinanced, and the federal government has a massive incentive to ensure that those rates are as low as possible. The debt that we're paying on is just a huge part of our overall budget at the moment, and to not get into some type of significant debt spiral, interest rates really need to come down. So for more reasons than just the mortgage industry, something we're talking about, in the overall scheme of things for the U.S. federal government, the overall interest rate with all these refinancing coming up is also extremely important. So I do think that there's a lot of incentives beyond just the economy itself, beyond just the mortgage industry, for downward pressure on rates for the Fed. So hopefully we see some good things over time.
And there's a couple of levers that you can pull, Wade. One of them being inflation, obviously. The other one is if we can just make it attractive for the Fed to change their balance sheet stance and maybe take on some mortgage-backed securities, or even incentivize the private sector to buy mortgage-backed securities, and you create a little bit more competition, then you will see it come down.
Yeah, for sure.
Both of those things are very viable options in 2025.
Yeah, for sure. 100%. Let's go to this next slide. Housing affordability. Jeff, I know you're kind of excited about this slide. You want to talk about it?
Yeah, I mean, it just basically what it is it's a measure of U.S. income have spent 42% of their earnings on a monthly housing costs to buy the typical home. So it's basically a ratio of your income relative to the typical house payment. And if you look, starting in 2012, so it was all the way down to 23%. It spiked up to 42 during this run up, but it came back down. It came down last year, which is what I was referring to. I thought that might be a positive trend, that things are hopefully loosening up a little bit. And the reason was wage growth outpaced the growth in the payments. So it's good that it's kind of catching up to where, because we want, I think for a healthy economy in the long run, you have to have some kind of affordability in the housing market. It's just, this number can't keep going the wrong way where nobody can afford to buy a house. So I was encouraged that it's starting to come down a little bit. Hopefully it stays that way next year as well. But I just thought this was positive news we should share.
For sure. I'm of the opinion we skip this slide and get over to the affordability index. We have a few minutes left before questions, but I find this really fascinating where we're at right now. And you can see that, for example, we were talking about San Antonio earlier, and you look at the income in Houston being 63,973, San Antonio being 63,077 on household income. What's interesting about Houston and San Antonio is that that's a large footprint going into this data. If you look at Dallas, there's a lot of small areas not included in that 67. So you got Irving, a much higher number, Plano, a much higher number, Arlington, a higher number. So Dallas's number is a little bit more complicated. But if you're just looking at San Antonio and Houston as an example, you can see that Houston's at 365 average home price. San Antonio is way down at 283, despite having incredibly comparable average income. So I'm of the opinion that San Antonio has a lot of upside potential on prices and rents, and that it's incredibly affordable at the moment, considering it's also one of the major metros here in Texas. But you can see that because of the steadiness of the Texas market, Austin was the 22nd most affordable, Dallas 25th, Houston 42nd, and San Antonio 67th a year ago. And they are all less affordable at the moment because Houston has remained, well, Texas, I'm sorry, has remained a little bit steadier on prices. A couple things that jump out to me on this report. Anything else jumping out to you, gentlemen?
Number 87.
Yeah. Well, so I know the last time I was on here, I was talking about Lubbock. Obviously, Lubbock has affordability, but I'll throw another market out there that has an opportunity if you want to buy and hold. I think Corpus Christi has a huge opportunity. It's a former military base right by the airport. There's a lot of post World War II housing that has aging people that are aging out, and that's coming on the market at a very low price. So even at high rates, you can cash flow. And I just think there's opportunity there because people make good wage there. Insurance cost is okay. It's insulated in certain areas. It's far enough in where it's not a flood zone or issue. So I think that it's another one of those markets. Lubbock for a different reason. I think there's a multi-unit play that you can do in Lubbock because one, it's affordable, and two, they're really expanding the university there. But in Corpus, I just think you have a lot of older homes that are available that are still desirable for rent. And people make a good wage there. So last time I was talking about Lubbock, I think my call out this time would be Corpus.
That is something I didn't think about, like the percentage of homes that are older, because that's what you're looking. That's like the sweet spot, right? You want to find older homes that you can rehab, buy at a good price at a discount. Use hard money to rehab and fix them up, and if there's a good tenant base, you can buy a lot of them probably for not a lot of money.
Yeah. So at the end of the day, I think that this is a very positive overall report for the places in Texas, because if you think about especially the major metros, very comparable amenities to some of these cities at the top that it's just hard to even wrap your head around that. The average home price in Los Angeles is 1.13 million, and the average person only makes a little bit more than in Austin, and I'm sorry, than in Houston or Dallas, and less than in Austin. So I mean that's pretty telling. And then of course you got some other towns you can see as well, Miami, New York, that the numbers are just entirely different, and that people are going to want to live in cities that have great amenities like the major metros in Texas at a far better price. That's why so many people are moving here, obviously. So it's a great story going forward. Do we have any other questions, David, or are we at a good spot to wrap up? I know we already covered several today. So one more.
I think we hit on pretty much all the questions we've
Oh.
got.
There is one question. Does NRL offer commercial loans? I see. Steven,
Yeah, Jay, I can speak to that. We have a referral relationship with a lender that we can kind of make sure that you're given to a trusted person that we've vetted, but we do not have that same ability to underwrite, close, and fund them ourselves.
Yeah. All right. Great question. We have a contest to speak about here, David?
Yeah, we have a winner for, I believe it is half off of processing and catalyst funding.
Yep.
Our winner is going to be John Emberton.
Ready to go, John?
Congratulations, John.
Congratulations, John.
Maybe the name's just familiar, but has he ever won before? Is this a two-time winner?
I don't think so. I'm looking, I don't see that, so we'll see.
Anyway, Stephen, thank you so much for your time, my friend. A lot of great insight. Thank you, David, for handling the monthly market update this month. You did a great job on the presentation.
Thanks,
Thank you, Jeff, as well. Everybody out there, really appreciate your time and happy investing.
See you guys next month.
Thanks, everybody. Thanks, Stephen.
Yeah.
Thanks, Steve. Bye-bye.